As a buyer, it is important to take the time to get pre-approved. A pre-approval is a letter from a loan officer that states you have had your income and assets verified and are ready to purchase a home. You should be pre-approved before you start looking for a home, because if you fall in love with a home, you'll need proof that you can afford this house by providing the seller this letter. The pre-approval process is pretty simple. You'll meet with a loan officer of your choice, and they'll ask a bunch of questions, run a credit check, and verify your income. It usually takes a few days to get the pre-approval, but once you have it, you're good to go. They can offer you different kinds of mortgages, such as an FHA loan, a conventional loan, an ARM product, and a VA or DVA loan. We'll briefly talk about each of these types of loan products. The FHA loan is a product for first-time homebuyers. It stands for Federal Housing Administration. It's a loan that is insured by the federal government, Housing and Urban Development, or HUD. Since it's insured by HUD, the criteria for the loan can be a little more relaxed. They allow for a down payment as low as 3.5% and also allow for a lower credit score than a conventional loan. The FHA loan has an initial upfront mortgage insurance premium as well as a monthly fee. With this type of loan, the house has to meet certain minimum lending requirements through the appraisal process. The conventional loan is the most commonly used loan with a minimum of 3% down. Anything less than 20% down and you will need to pay private mortgage insurance. This product also requires a higher minimum credit score to qualify. The VA loan and the DVA loan, which stands for the Department of Veteran Affairs, is a special product designed for veterans. This unique product gives a benefit of 0% down as a competitive interest rate. The final loan type we'll discuss is the adjustable rate mortgage. For example, a 7-year ARM means that the first 7 years will have a fixed interest rate, which is usually lower by a significant amount compared to a 30-year fixed conventional mortgage. After the 7th year and every year thereafter, the rate can adjust. There are usually limits as to how much it can adjust. For example, a maximum of 2% per year with a lifetime cap of 5% higher or lower than the initial interest rate. An example is as follows. If you obtain a 7-year ARM at 4% today, in year 8, it could go to a maximum of 6%, in year 9, 8%, and in year 10, 9%. Remember, these caps are different for each bank. The benefit of an ARM product is that the interest rate is significantly lower than the 30-year mortgage. Stay tuned for more tips on buying a home.